Hello, everyone. Good morning, good afternoon, good evening, wherever you are. My name is Hoda Mer. I'm founder and CEO of Stockcard. And today I want to go through the Upstart stock. Upstart, ticker UPST, is a stock I've had on my watch list for a long time. I know a lot of stock guardians and people who use our users on the Stockcard platform actually have this stock on their portfolio or on their watch list. And it's been a roller coaster holding this stock or watching this stock. A lot of people love it for its future potential, and a lot of people hate it because of its recent fall. So today it's a research session. I'm going to try to do in the next 15 to 20 minutes, go through this research together, and then go through figuring out whether this stock, Upstart, this company has the potential to become a 100-bagger stock. So without further ado, we're going to jump in, do the research together. If you are watching live, please share your comments, share ideas, share your thoughts, do the research with me. And if you're watching a later time, you're watching the recording, make sure to share your comments in the comment section, or come to Stockcard platform and live chat, use the live chat and chat with me or some other folks at Stockcard and share your ideas there. All right, let's get started. What I want to do first is just go through a little bit of the reasoning behind why Upstart it's such a roller coaster in a way for a lot of the folks in the community, in the Stockcard community. Let me share my screen with you. Here we are, and there we go. Actually, let's make it even bigger, a little bit bigger. There we are. Okay, so let's go to Upstart's Stockcard. If you're not familiar with the Stockcard platform, Stockcard brings digestible insights to your investment research. So you'll see in a few seconds how we do that. And if you haven't used it, I highly recommend you sign up. It's free to use. And obviously there's a paid version, but a lot of our users actually use the platform for free. Let's make this screen a little bit bigger for you guys. And let me know in the comments if you don't see it or if you want to make it more bigger. But from my screen, it seems like it's a good size here. Okay, so Upstart Holding, I told you about this being a roller coaster, and I want to tell you why. So about October, this is basically the one-day chart. It's down a little bit, but let's look at a 5-year chart, and it doesn't have 5 years of history actually. It's only went public in 2022 IPO. As you see on its stock card, you could see that it's a 2022 IPO company. So I put a 5-year, but it's basically like a 2-year of history. But in October of last year, almost about the same time, this stock was almost $400 per share. And now this stock is $23 per share. So even if it can go back to its all-time high of $400, that's a significant jump. It's not a 100-bagger stock, even if it goes that high, but it's still a significant amount of growth for this stock to get there. For sure, analysts, if you think about it, analyst here, we're looking at the analyst upside estimates, and analyst thinks that the stock can grow almost 100%. So not 100x, but almost 100%, so double from where it is right now at $23. So this is significant. This is at least a lot of people are excited about it, and a lot of analysts think that is at least a doubling potential for this company. So we're going to go through this research from scratch together and look at all aspects of this company and figure out whether it is truly can it go back to the $400 per share, or can it even be much bigger company and give us that 100 times growth that I am absolutely obsessed with. I don't know about you, but I'm absolutely obsessed with finding 100-bagger stocks. I think that's the true excitement of investing in the stock market and investing in general. And that's why I'm always in the pursuit of finding the next 100-bagger. And if I can find a few of them in my portfolio in my lifetime, that would be fantastic. All right. let's go through the framework of 100 baggers. So let me make this a little bit bigger for you. I am using here the framework, the 100 bagger framework by Chris Meyer from his 100 baggers a stock or 100 baggers portfolio. It's a fantastic book. If you haven't read it, I highly recommend Chris Meyer. And I think it gives you a very good foundation to find those 100 bagger stocks. These are a few things that you would want to consider when you're evaluating a 100 bagger company or 100 bagger stock. Some of them are basically clear as of now, and we just talked about it. For a company like Upstart, it is when you want to get a 100 bagger company, you're looking for companies that have small market cap that allows them to grow significantly. So if you're investing a $1 trillion company or something like Apple is more than $1 trillion, it's very difficult to think about how it gets to become a 100 bagger from where it is right now. Because if Apple becomes a 100 bagger, maybe that's bigger than the global GDP as of right now. So that's very significant. But for a company like Upstart, if you go back to the stock card, which we were reviewing together in a second, in the key information section, we'll see this company is almost just a $2 billion company. So a $2 billion company has that runway or that space, that possibility of growing by 100x, and it still be a relatively normal sized company, especially in a financial services industry. So if you look at this, if you compare Upstart with other companies in financial services industry, I'm looking at something like Mastercard, who is actually one of the historical 100 baggers that had you invested in it way back when, you would have had truly a 100 bagger in your portfolio. But when we're comparing these two companies' market cap, although they're both in fintech, financial technology, but not exactly in the same service. Mastercard gives you credit cards and process the payments. Upstart is a loan provider. We're going to get to it in a second. But I want to show you why it's possible for Upstart to get actually to that 100x because of its size. It's because Mastercard's market cap is $298 billion, and Upstart market cap was about $2 billion. So that's the aspiration, right? That's where we want to get Upstart to get 200x and to become a company the same size as Mastercard. All right, so let's go back up. Let's go back to our framework, and that's what I was just showing you. The company is small enough in terms of market cap to get to has a runway to be able to 100x. Does it have history of compounding? That's the second characteristics of a 100 bagger, and we know there's this rule, I guess there's this pattern in the stock market that we should talk about, is that the companies that are growing, they continue to grow until something significant breaks up their momentum. So when a company is on a trajectory of growth from a revenue growth perspective, price growth perspective, profitability growth perspective, these are not like one-time events. When you set up the foundation of a company to grow, this is going to be continuing for a significant period of time. And so that's what that's one thing that we should investigate together. For something like Upstart, we certainly know from in the last 2-year period, from where it IPO'd around $44 when it got to almost like a $400, it had that history of compounding in terms of price, right? So certainly it has been able to achieve significant growth. It's not impossible for it to get there, but we want to look at it together and figure out whether it has more in it. Can it go back there? Can it go even higher? And then the other thing that really grabbed my attention that I thought might be very interesting to look at Upstart from a 100 bagger point of view is that there's a possibility of do we have a chance right now to buy this company at low multiple? So yes, it's great to find great companies like Mastercard we just talked about, but everybody would want to pay a lower price, right? Everything equal, you would rather to pay for a great company at a lower price. So if you find a company that has the foundation of becoming a 100-bagger, if you find a chance, an opportunity to buy it at a lower price, at a lower multiple, that's even better, right? You can get to that status much faster. So let's look at the valuation bucket for a company like Upstart. And it is still an overvalued stock, but let's look at it and see whether is it like significantly overvalued, or if we buy it today or sometime in around this time, and do we get the opportunity to buy this company at a better price? So from a price to earnings perspective, Upstart is about 25 times earning. It is not extraordinarily expensive. We have seen this company as such a higher extraordinary valuation, right? But compared to its peer, and compared to where the market is at this point, it is still like a relatively overvalued stock. When you look at its forward price to earnings ratio, it's lower than its current price to earnings ratio, and that basically is an indicator that analysts or the people who are reviewing the company are expecting for the company status to get better, to have like higher earnings. So when you take current price and divided for the future earning that is expected to be higher, that means the company is going to be in a better status. So that's why that's a good sign from a valuation point of view. The other thing we want to look at is price to sales ratio. So price to sales ratio of 2.1, basically at this point, all analysts or all the stock market is pricing this stock to be at is at 2 times its sales, meaning that we only think, or the stock market only thinks, that this company has opportunity to double its revenue, and that's it. So that's what we're pricing it. And truly, if we go and invest in the company now at the current valuation, and if it manages to become a 50-bagger or a 100-bagger, we're going to pay a really, really good price for this stock. And this is not a sort of a company, it's really a growth company at this point because of its size, because of where it is in life, and because it's only been an IPO 2 years ago. But even with a valuation metric such as price to book value that is usually used for more mature companies at the later stages in their lives, but even in that case, the company is only priced at 2.6 or almost like 2.5 of its book value. And that is also quite interesting. It basically just shows the company could be really undervalued. It's still higher than its peers. It's still not as cheap, but there is still a lot of growth is expected. As we saw, analysts are expecting this company to be, in terms of opportunity, at least there's at least 100% growth as expected from this stock. So it is an overvalued stock, but it's not extraordinarily overvalued, which gives me there's an opportunity to buy this stock at a lower multiple at this point, which is fantastic. That's what you want to do. But what is going to break or make this model and this analysis today is these 4 other questions that I've outlined here. And we're going to go through Upstart's information. It's a stock card, it's the earnings information, it's annual information, it's leadership on its website, and gather this information what we need in order to make a decision whether Upstart can be a 100-bagger or not. So one of the common characteristics of a 100-bagger company historically has been that they've been able to generate free cash flow. So forget about the profitability of the business, but a company that generates free cash flow, it means that it has been able to generate or create a business model that can generate enough cash. And that's very key, because if you have a consistent free cash flow, you can reinvest that money into your own operations. You don't need to keep going and borrowing or raise external capital. And that's a fantastic sort of like a key or fuel for your growth. So let's go and see whether Upstart has that free cash flow generation capabilities. So on Upstart's stock card, we can go under the financial strength section, and this is, if you're not familiar with this section, is where we show financial information from annual reports, from cash flow statements, and from balance sheet to help you decide whether this company has a solid financial status. So one thing we're looking at it right now is free cash flow. It seems like the company has positive, based on 5 different analysis, has positive free cash flow status. And I'm going to get a little bit more information. So what's going on is very interesting. In a quarterly point of view, the company 2 quarters ago had 272 million in negative free cash flow, and 1 quarter ago it reduced the negative free cash flow to 60 million. So although both of them are good, are in negative, meaning that the company doesn't generate a free cash flow, at least in the last quarter or last 2 quarters, what is quite important is that it's free cash flow growth quarter over quarter. It's significantly in a better status. So that's what we want to see. So from this, what we see right now, from a quarterly point of view, at least, the company is not a consistent free cash flow generator, but at least it is moving towards the right direction. And so if we go back to the company's stock card and look at its key dates, the company is expected to release its next earnings on 8th of November. So that would be a very good question to answer. I always, when I'm getting into the earnings season, I always have a list of questions that I would want to get answered when I'm reviewing those earnings reports. So here I'm going to put those questions down. So one of the things on November 8th that it releases its earnings report we want to watch is that how consistent is the basically free cash flow status, right? How consistent is the free cash flow? Has the company managed to get closer to positive free cash flow? Positive free cash flow from a quarterly point of view, right? So if I go back to our framework that we're reviewing together, is that from a free cash flow generation, there's some questions about it. We're not 100% sure yet whether it's not consistent, and we want to see how it goes, right? How it goes. Can it get into that consistent free cash flow generation status? The next interesting aspect of a lot of 100-bagger companies out there based on Chris Meyer's methodology is that, let me make this a little bit bigger for you guys. Here you go. Okay. I hope this is better. Okay, the next thing we want to look at is whether the company is being run by skilled leaders who have a significant skin in the game. So how would you have a skin in the game? Either you created the company yourself, you founded the company yourself, or you are basically is hired from outside, but you have a significant amount of share in the company. So your personal incentives are aligned with the company's growth and incentives, right? That's why a lot of frameworks, when they talk about leadership quality, everybody would look for founder-operated companies who are skilled to run that company. So to get that for a company like Upstart, I went to their website, and under the About Us section, I found a list of company's leadership. So Dave is the company's CEO, but he's also the co-founder. And that's what you want to see, right? You want to see companies that are run by the original founders. It's not always possible, but it's a really, really good sign. Again, it's about alignment of incentives between the founder and the shareholder. You always would want to look at that. It's also not only him. So it sounds like all the original co-founders of the company. Paul is a CTO, and he's also in the company. And Anna was also a co-founder, and she's still running the company's business operations. The other thing I did is that I went to LinkedIn. I don't know if you use LinkedIn in your investment research at all. I actually use it significantly, and I look at the background of the leadership of the companies that I'm investing in. So Dave is founder and CEO of Upstart. We just looked at it. and I wanted to see where he comes from, right? So in 2012, he founded the company. Before that, he was at Google, and for 8 years, he ran the enterprise segment. So that's interesting because it tells us that the CEO has history of managing enterprise customer relationships, building technology products for enterprises, which is a good sign. And he was a product manager at Apple and some other experiences. So from a experience point of view and from a management point of view, this company is definitely run by its founder operated. I haven't pulled their equity ownership in the company, but chances are that this is something you could also get from the company's annual report. But I basically give it a good score because it is a founder-run company. And we just saw at least the CEO has the right background or experience in the industry to be able to run that company. The next two things we want to look at is, does the company have the ability to grow? This is, if you want to look for one criteria to find the next big 100 bagger, you need to look at the revenue growth, because everything else equal, if a company can actually grow its revenue, it means that there is proof in the market that there's demand for it, and everything else can be managed. Everything else can be designed or fixed, or every other problem can be fixed. But if it's a company that hasn't been able to find a way to find good customers for its products and services, that's a big red flag. So I want to look at that revenue growth on Upstart, and I go to, if you remember, I told you on a company's stock card, you can get its financial strength and what is the revenue growth history of that company. So it sounds like on the financial strengths, Upstart have a strong and growing revenue based on 6 different analysis. I'm going to take a look at it together. 228 million in quarterly revenue and 846 in annual revenue, and based on its latest reporting. But this is the red flag. Quarter over quarter, Upstart's revenue has been down by 26%. And that's a red flag. There's something going on in its operations. Something that gives me a little bit of peace of mind is that on an annual revenue growth point of view, on an annual basically a year-over-year point of view, the company had a significant jump in its revenue. And that's probably why we saw, along everything else that was happening in the stock market, we saw that the stock's price from its IPO went down of like $40, went down to all the way to $400 and almost like $400, 390, is because investors saw this almost 300% in revenue growth, and they thought, oh, this could be the next 100 bagger. So that justifies it. And even if you look at it, this is another good piece of information, is that if you look at its 3-year revenue growth compounded, so 2022, no, 2021, 2020. So if you look at that, it has been growing at 128% per year. So those are good numbers. What is a little bit interesting and worrisome is that on a quarter-over-quarter basis, the company has been declining, and that's something we would want to watch for. I did want to take a look at the company's revenue figure on its latest quarterly earnings report. Let me make this a little bit bigger for you so that you can get a better sense. So this is the last Q2 earnings result by the company. And then you see that in Q2, we had 228 revenue, Q1 of last year, 300. And Q2 of last year, we just talked about it. Year over year has significant growth. 3 year has significant growth. Quarter over quarter did not have that much of significant growth. What I would say here is that this could be the result of the interest rate. So because Upstart is in the business of giving people loan, and mainly car loans, and I know for a fact, actually, when my husband and I were basically making some vehicle loan transactions recently, we realized this is the rate, the annual interest rate. On your car loan, if you want to get a new car loan, it's significantly higher. Maybe a year ago you could get it, or in even Q1 you could get it in 2-3%. Now 6%, 7%, 8%. It's a crazy amount, crazy interest rate. So this may not be driven, this drop may not be driven by the company's performance. It could be market driven. But then yet again, if you're in the business that the only thing you do is highly correlated with the interest rate, you will have this cycles. So I'm not as worried, because it doesn't really, when you would be very worried is that when you look at the company's operation and you realize this hasn't been able to find that a wheel, if you wish, of generating revenue, that's concerning. For Upstart, it's still a question mark. So it could be this is just a bleep, and the company will find its way to continue growing its revenue. So that's another question that we would want to get answer when we get into that quarterly earnings report, is that has the company found, or what would the management say about its revenue growth potential? Has the company found a consistent way to grow its sales, its revenue, right? And that's quite important. We will watch for it in the next quarterly earnings, but that's basically it. We don't know, right, as of now with the current information. And we're almost coming to the end, but talking about good companies, well-managed companies, the companies have found a way to grow their revenue. I want to tell you about our fundraising on Republic. So recently we launched a crowdfunding campaign on Republic, which is the leading crowdfunding platform for startups like us. And what it does is that what we want to do is to get our community, people like you who use the stock card and see value in using the stock card, to not only use the stock card, but be a part of our future and be a stakeholder or shareholder of the company. And hopefully, as we build that 100x startup or a 100x financial technology company with a stock card, you would be a beneficiary of that 100x gain. So please, if you haven't looked at it, go on to republic.com/stockcard, republic.com/stockcard. Take a look at our information there. We've shared with you on the traction. We've shared with you our revenue growth rate. We've shared with you our user growth rate. And we're so proud of the traction we've had. And we're basically very grateful to all of our users and our community for using the platform. But that basically tells you that when I was telling you on the next 100 baggers, these are the evidences of building a 100 bagger company that has been able to consistently grow its revenue, grow its profitability, grow its users. So head on to republic.com/stockcard and join us as an investor. We hope to have you with us on Republic. Back to Upstart, we're in the last piece of our analysis. Does the company have competitive advantage or moat? So I know when it comes to competitive advantage, a lot of people look at things like, basically the competitive advantage is technology. So that it becomes a very qualitative analysis. But what I've learned from a lot of my investments is that if you have competitive advantage, it would show itself in your financial metrics. So let me repeat that. If you have competitive advantage or moat, it would show itself in your financial. How? Either you have a really high margin, gross margin. So when you take your top line revenue and you remove the cost it takes to sell your product to deliver your product to your customers, that gap is not that big. For example, on the stock card, our gross margin is something about 80%, meaning that it is significantly high. When we add new customer, it doesn't take us a significant amount of capital or an incremental cost in order to serve that new customer. Every new user for us doesn't bring that much extra cost. So that's one way. That means that this is a very efficient business. And you do want to go after investing in efficient business because that's a competitive advantage, right? Compared to its traditional competitors. Some other competitive advantages in profitability. It could be in the core technology. So going to Upstart stock card, let's see if we can find those evidences of competitive moat, right? One thing that is quite important when it comes to competitive mode is that what kind of technology this company uses. And the whole thing that Upstart has is that it uses AI, artificial intelligence, in evaluating creditworthiness of customers when they want to get, let's say, a car loan. And that means this company, generally compared to its competitors like banks or traditional credit unions, it has a lower operating cost, right? And I was looking at the companies, we were looking at it together in a second ago. It basically shows itself, it's in financial information, right? So 73% of the loans that are run or basically processed by Upstart technology are fully automated. And that's competitive advantage, right? That means that this company can have a much lower cost compared to its competitors when it comes to processing and servicing its customer, and that to me translates into competitive advantage. So for its competitive advantage, I'm going to give it a good score, meaning that it does have a competitive advantage. Obviously, these things changes, right? Because a year from now, maybe every bank out there is using some sort of an AI, so it loses its competitive advantage. But as of now, this company certainly have a very good competitive advantage from its AI point of view. So let's wrap it up. We've been talking about for 30 minutes about Upstart. We have some good scores and we have some bad scores or questionable questions about its operation. Let's recap. It is small enough, $2 billion market cap. It can become a $200 billion market cap, similar to some companies like Mastercard, and become that 200x or that 100x growth story. It does have a history of compounding, so has been able to achieve from $40 to $400 almost in price. It does have that history, so there's opportunity for it to get back there. Do we have a chance to buy it at a lower multiple? Yes. So we looked at its valuation early on, and although it's not a very cheap stock by no means, it's still on the stock card is ranked as an overvalued stock. But even with metrics like price to book value, which is a very different metric, which is a metric for much more mature companies, but even with that criteria, the company is sort of in that fairly priced range. So if it is become a 100-bagger company, and if you buy it now, we do have that advantage of really paying a lower price. Generating free cash flow consistency, that was a question mark. We looked at it. It's negative free cash flow from a quarterly point of view, so we're not sure about it. This is one thing we would want to have an eye on it in the upcoming quarterly earnings report. From a leadership point of view, who have the skin in the game, it sounds like all the co-founders are still there. It's the original leadership team who coming from Google, who are coming from technology background. So we like that. We believe it's a good company. It's a good leadership team with a skin in the game running the company. Does it have consistent revenue growth, which is one of the most important metrics, as we talked about, for a company who become a 100-bagger? That is, again, questionable. We looked at its revenue growth is down quarter over quarter, so that's something we would want to take a look at in the upcoming earnings release. And from a competitive advantage, just because it is the creator of a technology, AI-based artificial intelligence technology, that can reduce the cost of serving loan or approving or processing a loan for financial technology companies, for any financial company. It sounds like it does have those early evidences of developing and establishing competitive advantage. So all in all, I'm not ready to put my money in Upstart. I do want to take a look at its consistency of its free cash flow and consistency of its revenue growth before I jump in. And those are the two questions we wrote down together, right, a few seconds ago. We wrote down these 2 questions. Going into the company's earnings release on November 8th, we would want to know how consistent is its free cash flow, or what would the management say about its ability to generate free cash flow? And then has the company found a way to consistently grow its revenue and its users? And that's, again, they may not even grow their revenue because of the impact of the interest rates and because they're in the business of giving people car loans. But we do want to hear management's perspective on how do they plan to grow their revenue and users in upcoming years. Really, quarters doesn't really matter when it comes to basically buying or finding the next 100 bagger. So altogether, Upstart didn't find its way to my 100 bagger portfolio, but I am watching it. Here, it could be potentially a buy and hold, and as you see, 79% of people or users on the Stockcard are buying and holding this company. Had you owned it, had you bought it when it was $400? If I had owned it at $400, I would probably still keep it. It does have those early signs of becoming a 100 bagger. It's not just there yet. So I would personally wait for that November 8th earnings release, or perhaps 1 or 2 earnings release to confirm those things that I have concern about, which is free cash flow and revenue growth. And had I owned it, I would have probably kept it. Thank you for being with me. That's about it. We went a little bit over the time that I allowed it. I wanted to get this done in less than 30 minutes, but I think there was a lot of good things to talk about it. Let me remind you again, we are raising a crowdfunding round on republic.com/Stockcard. And we truly believe we're creating the next 100 bagger in financial technology services industry. So if you haven't yet joined us as an investor, go ahead on republic.com/Stockcard. Take a look at our team, take a look at our traction, our sales growth, our revenue growth, and our vision for the future of retail investing. We truly hope to have you with us as users, but also as investors. With that, thank you again, and hopefully you will be back on the future live streams and join us in another good stock research from scratch. I'll see you very soon. Have a great rest of your day.